just about anybody who has a business plan and understands what the key drivers of their business and their industry are is ready for equipment financing. You could either save up the money that you need to buy a piece of equipment, or if you finance the equipment, you can have that equipment earn money for you as you're paying for it.
As a small business owner, what indicators would you cite as things that suggest you're ready for equipment financing?
We like to say that just about anybody who has a business plan and understands what the key drivers of their business and their industry are is ready for equipment financing. If you think about it from the perspective of a business owner or a decision maker in a business, you could either save up the money that you need to buy a piece of equipment, and it could take a long time to save up 100,000, 200,000, sometimes even more. And then you're looking at a payback period. So how much are you going to earn, or how much money is that piece of equipment going to save you? And the payback period, a really good payback period is, let's say, 18 months to 24 months, and sometimes it takes 5 or 6 years. Whereas if you finance the equipment, you can get the equipment a lot sooner because you don't have to save up your hard-earned cash, which probably is better served being put into working capital purposes. And you can get that piece of equipment with either no money down or a minimal amount of an upfront payment, and have that equipment earn money for you or save money for you as you're paying for it. So the equipment typically pays for itself. What we're doing is, in our industry, we're changing the equation from what's my payback period to how much positive cash flow am I generating every single month. You're almost ROI positive from the get-go.
Okay, so for basics, how does one qualify?
If it's a small business and the business does not have a history of profitability, and the business, let's say you haven't accumulated any retained earnings in your business or equity in your business yet, then we're going to be looking at mostly the credit history of the owners of that business. So if you think about it this way, a lender doesn't want to have more risk in a company than the owners already have. And in terms of getting ready to borrow money, make sure that you're paying your bills on time, both in the company as well as personally, because a lot of lenders look at the personal credit of the owners, not just because they're taking a personal guarantee, but because how you run your personal finances is going to dictate, or going to be a really good proxy for how you're going to run the finances of your business. So make sure you pay your bills on time. It's much more important to pay the minimum amount that's due instead of paying the entire amount off of one loan and then being late on others. Having available credit. If you're starting up a business, go out before you start up the business, take out your loans, take out the equity loan on your home for the additional capital you might need. Because before you start the business is your best time for the next couple of years until you achieve profitability to borrow money. You know, if you're an established business, then you can expect to get a loan without having to take any kind of personal liability, without having to personally guarantee the transaction. And then obviously, if you're a very strong credit, then you can dictate terms to the lenders as opposed to vice versa.